After such a sense of anticipation building up to this week and the long-awaited central bank decisions, it was a fizzer across the board. First, no change to interest rates in Japan, then nothing from the FOMC in the United States, and in quick succession the Kiwis followed suit. Much ado about nothing. Despite this inaction, stock markets took no change as good news, with the US and Europe higher, and looking at Japan's Nikkei index here, you can see that their stock market had a healthy 2.5% rise. So the Japanese market looks well positioned now to start to build momentum, and assuming the Nikkei holds the 15,000 mark, we could see a very strong upward move from here. In the US, the message was mixed. Paraphrasing one of the quotes, the case for an increase in the Fed funds rate has strengthened, but we've decided to wait for further evidence. An indecisive decision. But December remains the likely timing for US rates to rise, which together with the US presidential election is why we are calling for a sharp rise in volatility in all markets between now and November. Meanwhile, the Aussie dollar has been pushed and pulled by these offshore events, but now appears poised for a major breakout by finally escaping the 74 to 78 cent band it has been trapped in for so long now. But which side will break? Our new RBA Governor, Philip Lowe, in his first appearance at the House Economics Committee, commented yesterday that a lower Aussie dollar would be helpful. Although he also said that the recent rise was understandable given the rise in some commodity prices and the weakness in the US dollar. Our suggestion is a break on the top side is more plausible than the downside. But the one outcome that would really surprise us would be for currency markets to remain range-bound. There are too many at-risk events imminent to warrant stable currency, bond and stock prices. For the next few weeks, beyond AFL and NRL Grand Finals, the focus will be offshore and any fresh leads on China's economy and to a lesser extent Europe. Both are at risk, but for now, bad news is staying out of the headlines. Again, we do expect volatility to build from here and event risk is high, so we'll keep you posted as to how markets are coping with these treacherous conditions. Until next time, that's the market update from Bendigo Bank.